Hi, I'm Kevin O'Leary. You might know me as Mr. Wonderful on Shark Tank, and I really enjoy doing that show because I love to support entrepreneurs. But my real job is I'm an investor. I'm entrusted with a lot of capital, both my own and other people's, and I have to put it to work. It's a huge challenge because let's just take my family trust. I've been investing it since 1997 with the Board of Trustees. You know how hard it is to do that in volatile markets. But here's my challenge. When I set it up, it was a very simple mandate. And I want you to understand it because it's the genesis of something I've been part of creating recently called O-Share ETFs. First of all, the trust. 1997, I said, let's do 50% equities and 50% fixed income. And we put in place a mandate, remember this is multi-generational for 100 years, that it would pay out 5% a year. Sounds so easy to do. And it was in 1997 because you simply had to buy long government-dated bonds. You could easily make 5%. Today, imagine how challenging that is. So as rates went down, obviously, I had to find new ways to generate income. Now, I learned something a long time ago from my mother. You're going to find this fascinating. When I was a 7-year-old boy, and she was working at that time, she used to take me with the bank to her every Thursday. That's when they paid the girls where she worked. And she'd take a third of her paycheck and put it into bonds and dividend-paying stocks. She used to say to my brother and I then, boys, never spend the principal, only the interest. I had no idea what she was talking about, but she was drilling that into my head for a reason and I think became very important decades later. After she passed away, I became the executive for her estate. And for the first time, I saw a secret account she kept from both of her husbands her whole life, made up of dividend-paying large-cap stocks and corporate credit. Do you have any idea of the performance of that portfolio? She blew away every indice. I was amazed. And she wasn't a portfolio manager. She was just a concerned mother that needed to have capital no matter what happened. I started to do some research. You may find this fascinating. Over the last 40 years, over 70% of the market's returns have come from dividends, not capital appreciation. She must have intuitively felt that and knew that. That forever changed my investment philosophy. I'm a dividend guy. I only buy stocks that pay dividends. I'll never buy a stock that doesn't return capital because the data tells you not to. Unless you're a masterful stock picker and you know exactly when to buy and sell, you can't, in my view, beat those odds. 40 years, 71% returns, that's it for me, dividends only. Knowing that, I decided to go into the ETF market and say, why don't I just buy a basket of different ETFs that pay dividends? Very inexpensive, easy solution. I love ETFs for that. And I began to do some research. I told my people, look, go find me all the ETFs in the market today that pay dividends. Now, I have some very simple rules that I have to live by as an investor. I'll explain them to you. And I have these rules in place for myself because they've saved my rear end over many volatile years in the markets. Number one, I never own more than 5% in any one name. In other words, I don't want my portfolio to have a lot of concentration. Number two, I never own more than 20% in any one sector of the S&P. I want diversification, there's no question about that, but also sectoral diversification. Number three, I hate volatility. So I want at least a means test on the market cap size of the company. Generally, larger cap companies are a little less volatile, but above all, dividend payers are less volatile. So I try to build portfolios that have less volatility because when you're a fiduciary for your own family's capital, preservation is number one on the hit parade. I think you know that. But I need those dividends. So my team went to work and they came back to me with about 50 different options. I was excited. This is an easy solution for me. We started to do digging into what these indices were made up of and what was inside these ETFs. And that's what I was quite surprised. The first generation of ETFs out there are indices that are market cap weighted. And for me, here's the problem. I'm not saying you shouldn't buy them, but here's why I'm not. I don't want the concentration that occurs in market cap weighted indices when one or two or three or four stocks end up being 40, 50, 60% of the indice. That breaches my covenant on diversification. I was kind of depressed at that point. I said, this ETF idea isn't going to be a solution for me because I can't avoid this massive concentration of a few names in the indice. And that's when I met the people at FTSE Russell. I told them the same story I'm telling you. Why isn't there something to solve my problem? Wouldn't other investors want the same thing? Don't you want diversification? And above all, dividend yield? I said, look guys, is there any way we can create something new? Here are the rules I want. Let's keep it simple. I'd like to have 20% less volatility than the market if possible. So backtest it a decade and show me that that fits. Number two, I only want to own stocks that pay dividends. By now you know that about me. Number three, can I get more yield than the generic index? Let's say 50% more? Because I need it. I have to pay out 5%, so I want as much yield as I can get. But here's what I've learned that's most important to me. I've been around a long time. I want some kind of means test on the balance sheet to know that the dividends are being generated by increased cash flow. I don't want any foolhardiness in going into which stocks to pick. For example, you remember that whole idea of accrued sales at WorldCom? I don't want that. I want cash flow. I want to test the company's ability to generate more cash to increase dividends. So I'd like a series of proprietary tests put on the balance sheets of these companies on an ongoing basis. FTSE Russell listened to me and they went to work. And that's how O-Shares was born. Unique. Unique for me, it's exactly what I want because everything of the covenants I've talked about are built into the O-Share structure and rules. The first product was OUSA, perfect for my holdings in the United States. Grooming through the market, finding the companies that fit everything I want, lower volatility, dividend yield, and the things that matter to me on testing the balance sheet, OUSA was born. It's perfect for my trust. It's what I'm using. Now, that's great for our domestic positions, but I also want geographic and global diversification, and here's why. This trust is going to last a lot longer than me. It's going to be around for multi-generations. In my family, I've decided not to give my children capital after they finish education. Sounds cruel, but my mother did it to me and it worked. My deal with my family is when a child is born into my extended family, even after I'm gone, I take care of them from the day they're born to the last day of education, and I'll do the same for their children. So this trust has to last a long time. How do I know in the decades ahead which economy is going to have the best growth rates? Right now, China's beating us in GDP, no matter how you look at it, and yes, it's more volatile. Europe looks terrific too. So I want exposure to all those markets. So I went back to the FTSE Russell and said, guys, can we apply the same rules to the other markets, the major markets, the European market, the Asian markets, including Australia, Singapore, Taiwan, Hong Kong? Could you do that for me? They said yes, and that's how new ETFs were born. OEUR is the O-Shares for Europe. Same rules as we applied to the domestic market, now in Europe. Perfect for me. Perfect for me because I'm getting geographic representation in countries like England, France, Switzerland, Italy, dividend payers only, and their balance sheets are tested. And right now, and this could change over time, but right now there's a lot of low PE stocks that are paying high dividends. I'm very happy. But what about Asia? Much trickier, much harder to deal with. Lo and behold, we applied the same rules to that market as well. Let's just recap those rules because for Asia, this is, for me, terrific. We want 20% less volatility. We only want dividend payers. And we definitely want more yield than the generic index provides. And on top of that, we want to test the balance sheets of these companies. So now in Japan, in Australia, in Hong Kong, in Singapore, I've got the best stocks for me and my trust. So here's how I'm using these tools. I want 50% of the trust portfolio to be domestic. That's OUSA. 25% in Europe. That's OEUR. And 25% in Asia. OASI. Now the equity side of my trust is completely diversified. There's over 140 names in the domestic OUSA, over 140 names in OEUR, and over 225 names in the Asian markets. That's total global diversification, sectoral diversification, and no name represents more than 5%. So what happens is every quarter we're doing the rebalancing, and every year the industry does its tests and moves names in and out. Perfect for me. Now, the trustees said to me, listen, Kevin, there's a lot of volatility in currency. We don't have to worry about that in OUSA. We're stateside. We're happy with the US dollar. What happens in Europe if we want to hedge against fluctuations in currency? And what happens in Asia? And the same. We'd like something hedged back to the dollar so that we can blend in the hedged amount we want at any one time. So we need different tools. For Europe, we'd like to have a hedged version of OEUR, and we have it. And that symbol is now OEUH. That's the hedged version of the European O shares. Those of you that manage portfolios and are fiduciaries understand you need a hedged tool. The same for Asia. OAPH. That's the hedge to the US dollar, O shares for Asia. So there's a family now of 5 investment tools in O shares. I'm not telling people what to buy. I'm telling you what I'm doing. This is someone who needed to solve his own problem for his own trust. What do I care about? Preservation of my family's wealth. And I've got to pay out 5%. The O shares toolkit is perfect for me. Now I've solved for it. Took me a long time to do it, and I think at the same time, I've helped innovate in the ETF market. I'm not going to be the last to do this. What's great about the ETF structure is that it can continue to evolve. O shares is a new generation of rule-based ETFs that make sure that what the index is comprised of fits the original mandate day in, day out. And for me, it's yield, preservation of capital, low volatility, not just in the domestic market, in markets all around the world. Anyways, thanks for listening. Have a look at O shares. It might solve your problems too.